Welcome to this week's version of Nickels and Dimes, our weekly video series. Well, obviously, the market's fluctuation depend on a lot of things. Economic drivers, for example, GDP growth or lack thereof, interest rates, company profitability. So theoretically, the more profitable a company is, the higher their stock price. A number of factors go into the market psychology. And of course, one of the main ones is emotions, and that of fear and greed. So emotions, whether we're aware of it or not, really play an important part of how we are feeling, of course, and whether we are confident or not confident about investing money. And of course, where we think there's opportunities or where there's not opportunities. So today we're going to jump into a brief overview of the psychology of a market cycle and get a big picture perspective and just give you an idea of where, at least in my opinion, our opinion, where I think we're at. So let's just dive in. So the psychology of a market cycle. Well, psychology plays, again, a key role in investing, and emotions that affect investing include fear and greed. We're all familiar with those, but are more diverse and can significantly impact results. Investor psychological profiles affect how an investor's profile performs because investing decisions are always directly linked to emotions. We do everything, whether we're aware of it or not, based on emotions. And most of the time, we do things to avoid pain or to avoid fear, if you will. And sometimes we make decisions based on greed and euphoria. So what does that mean in terms of investing and in a market cycle? Well, the Wall Street Cheat Sheet, that's a publication that put this together, looked at the psychology of a market cycle. And this is quite interesting. And folks often refer to this over the duration of a market cycle just to see where we're at and get some perspective. So things start out, for example, on the bottom left here, after a big drop with hope, a recovery is possible. So think back to March 23rd of 2020, after the market took a 33% drop from February 2020 to March of 2020. So things were tough, but people started feeling a little better after March because the market started improving. The Fed was committed to printing trillions of dollars and supporting the financial system. And then eventually it turned into optimism. Hey, after a few months, this rally became real. And belief, right? It's time to get fully invested. And then think about this. This is around summer to fall of last year. I will buy even more on margin. In other words, you may recall we talked about margin debt was an all-time high last year. This is where the thrill of the emotion comes into play. And hey, guess what? Eventually, you end up thinking you're a genius. We're all going to be rich. If you look at opportunities like some of the crypto investing, the NFT investing, even the electric vehicle space, there was a lot of euphoria and a lot of names. If you follow financial markets, SPACs, these types of things where valuations become unreasonable happen in the thrill or a euphoric phase of investing. So in the middle of the screen here, right after the euphoric phase, we have a downturn. This is when the bear market starts. And then we have complacency because we've had a little recovery. And then, folks get, look, we just need some time to cool off for the next rally. And then the bottom drops where anxiety comes into play. And then when things are bad and get worse, denial, right? So my investments are going to be back, or my investments are going to come back because they're with great companies. And then, oh, wait a second, things got worse. Panic shows up and I am selling and everyone's selling. I want to get out. And then capitulation, which is basically saying, I want out of everything. I can't afford to lose more. So this is the psychology of a market cycle. Well, this is the same chart on the left here, zoomed in. And on the right, this is actually the S&P from the March 2020 lows till most recently. Look how eerily similar they are. So if you think about it, and there's a line in the middle, this dotted line in the middle of the screen, April 21st. So let's call it just before summertime last year, the optimism and belief and thrill start coming about, where the markets were just roaring, and anytime there was a little pullback, it was let's just jump in. The big tech stocks and small caps, they're going to continue to outperform, and cryptocurrency, Bitcoin and Ethereum, they're going to go to 1 million, and 100,000 per coin. So this is, when the euphoria kicks in, and again at the market top. So last fall, we obviously saw the market started to pull back. And obviously this year it's been quite bad with, the S&P and the NASDAQ down anywhere from between 15 to 25%, depending on the time frame. That's that far right. You see where we've had the beginning of a bear market, and we've had at least the last few weeks a somewhat of a recovery. And now maybe people are starting to become complacent again. Now, if the past is equal to the future, which it tends to rhyme, then there's a reasonable chance we're in a complacent phase, if you will, where we're at the first downturn of a bear market, and hopefully things don't get worse, but there's a reasonable chance that well, especially because we have rising interest rates, we have inflation concerns. Things are challenging for a lot of people, and I don't have to tell you that. You see prices of goods continuing to go up, obviously influenced by oil, even though oil's pulled back most recently. So psychology of investing, fear and greed is always going to be prevalent. And no matter what our market cycle, whether it's now, 10 years ago, 50 years ago, or even 100 years ago, the markets have one thing in common, and that is human emotion. So do your best when you're investing to not have emotion dictate where you're investing. Let's go back to this again. Eerily similar between the hope, optimism, belief, thrill, that euphoric big rise up, and the rise that we saw in the market from March of 2020 till again last summer or fall, and then of course the downturn. You notice again we've had a brief recovery, and this is sometimes when people get complacent and then the bottom falls out. Now normally, if you look at a historical perspective, again, technically we're in a bear market, which, as you may remember, it's a decline of price from 20% or more from a recent high. We're technically in a bear market. Typically, bear markets, if you look at historical perspective, have 3 down phases. So a big down phase initially, folks get, think it's a buying opportunity, think it's just a pullback. Then we have a recovery. 5, 10, 15%, could last a few months, and then phase 2 goes down, and then of course a little bit of recovery, and then phase 3. In fact, 08, that's exactly what happened. We had 3 down legs. So again, no one knows what the future holds, but we would respectfully suggest you continue to be cautious. And hopefully, the markets stabilize, we can get inflation under control, and things can start, stabilizing, becoming, maybe more normal. That would be ideal, right? All that to say is, if you would like a second opinion on your portfolio or financial situation, go on our website at nicholswealth.com. In the upper right-hand section, click on the Contact Us tab, and certainly you could get a second opinion. We're happy to give you our thoughts on the market, and more importantly, how it affects you and your portfolio. Thanks again for watching. Bye-bye.